Options are instruments that give option buyer right, but not an obligation to buy the underlying shares at a particular price. So now, when we talk about options, so these are nothing but derivative contracts, wherein a contract is being created between a buyer and a seller. So let's understand how options work in Indian markets. So we are in the option chain tool in the application to understand the same, so that we can understand this concept, practically. So apart from just looking at the theory, we will understand how the things actually work out there in the market. So you can access the option chain tool from the link in the description box below or also in the iCard. This is absolutely free of cost to everybody. So over here, let's say if I'm buying a call option of Reliance. Now, what does that mean? That means I have a right to buy Reliance's underlying shares. Okay. I don't have any sorts of obligation whatsoever. If I'm buying a put option, that means I have a right but to sell the underlying shares of Reliance's. Okay. So now when I will exercise my contract, when I'm going to buy or sell the underlying shares, I'm going to buy or sell the underlying shares on 25th of May 2023. This is nothing but the expiry date. So in India, expiry date happens to be for monthly contracts. It happens to be on every last Thursday of the month. So in May month 2023, last Thursday is 25th. For June, it's 29th, right? So this will be the expiry days. Okay. If the expiry days, let's say if 29th is a holiday or when the market is not functioning, if it happens to be a bank holiday, then this would be the expiry date. Okay. So every last Thursday of the month is when we will go ahead and exercise the contracts. In India, as of now, we have European style options. That means you can't go ahead and exercise the contracts, and you can only exercise them on the expiry date. You can't exercise them anytime randomly, because in case of American style options, you can go ahead and exercise your contracts anytime you want to, right? Obviously in the expiry date. So in India, we have expiry date and we exercise or we practice European style options. Expiry date happens to be every last Thursday of the month. So in between are the strike prices, left hand side call, right hand side put options. So let's understand quickly what call option means exactly and what put option means exactly. So let's say if you are buying a call option of Reliance of 2460 strike price, then you have to pay 12.25 rupees as premium to get the right, because right is it's a comfort, right? So a comfort will come at a cost always. So this is the premium that you're paying for the comfort. What is your comfort? Comfort is, if you want to, then you can exercise the contract. If you don't want to, you can just let it go. So that's from the call option. So now what is this trying to tell you? That if you are buying 2460 call option, you have to pay 12.25 rupees as option premium. And this entire thing will give you a right to buy Reliance's shares at 2460. So in the future, let's say if on 25th of May, if Reliance happens to be at 2540, still you will buy Reliance's shares at 2460, because that is the price at which you have locked the contract. So strike price is nothing but it is the exercise price at what price you will buy or sell the underlying shares. So if you buy 2460, on the expiry date you will buy the shares at 2460. If you buy 2500 strike price call option, on the expiry date you will buy the shares at 2500. Okay, for the call option. Obviously on the put side it will be the same. You will pay the premium if you want to buy options, but over here you will get the right to sell the underlying shares. Okay, not an obligation, but again a right to sell the underlying shares. So now whenever you are bullish on the underlying,
Traders, Quantsapp has simplified option trading analytics for you. Click the link in the description box below, complete your sign up process and access the most advanced option analytical tools in the entire industry. Thank you.
call option is something what you will buy, and if you are bearish on the underlying, put option is something what you will buy. Now why is that? Because whenever the underlying goes up, let's say the future which is trading at 2458, if the future goes up, my call option premium will go up. Okay, but my put option premium will go down. But if the future goes down, okay, from the current level, then the call option premium will go down and the put option premium will go up. Now why does that happen? That happens because whenever the underlying is going up, the intrinsic value of the option premiums of the call side, it goes up, and the intrinsic value of the put option goes down. Whereas on the other side, if the underlying goes down, the intrinsic value of call option goes down, but the put option intrinsic value, it kind of increases. So apart from that, in an option premium, there are two types of values that attribute to an option premium. First is intrinsic value, which is decided by the spot, and the other one is extrinsic value. Okay, so in this premium, there exist two types of values. First one is intrinsic value, which is decided by the spot. Depending on where the spot is placed, accordingly our option premium will be charged. And other one is extrinsic value. So it is nothing but time value of money, how much time there is for the expiry. Okay, of that much time the premium has been accounted for. So that's that. So on the expiry, only the options which have intrinsic value, only they will have some value. Elsewhere, all the options will go to zero. If I just want to show you all, then navigate to what if analysis in the Quantsapp. Now let's say I am moving the day slider to zero. That means I want to see what will be the premium if I hold these options till expiry. Okay, so I am keeping it on 3. That means I want to see the premium till the expiry. So this happens to be 0, this happens to be 0. All these things are 0 because why? Because all these options are out of the money, and all these options which are having some intrinsic value, those are in the monies. So now question remains, how can you go ahead and calculate intrinsic value? So it is simple. For call option, it is spot price minus the strike price, right? If there is some value in the option, then that is an in the money option. If it is 0 or negative, that means it is an out of the money option. Intrinsic value cannot be 0. So the formula is very simple. Spot price minus the strike price. If there is premium, so 2458 minus 2400, the premium is 58. That means 58 rupees is intrinsic value. Rest, whatever the premium was, that was only because of time value of time. Same is the case over here as well. If you now see, in this scenario, for the put option, the formula would be completely opposite. Obviously, it would be strike minus the spot. And then you will get to see the extrinsic value. Again, the 0 which you are getting to see over here, those options do not have any intrinsic value in them. They just have the extrinsic value, which is time value of money. So over here, if you see strike 2560 minus 2458, this is the answer, right? So all these options are in the money options for the put side. And yes, do check out option chain tool in the app. We will keep it limited up till here. Do check out option chain tool in the application from the link in the description box below, and start to trade options in a data driven way, in a proper by looking at data points, pivotal data points out there in the market. And by the way, option chain tool in the application updates in real time, so do access it from the link in the description box below.